Welcome back to The Explainer. We're just going to skip the fluff today because we have a massive, absolutely fascinating topic to unpack. The greatest investing duo in history, literally. We're going to look under the hood of Berkshire Hathaway and break down the exact qualitative mindset and the hard quantitative math that built an absolute empire.
Okay, let's dive into this. Consider this quote from the late, great Charlie Munger, reflecting on his nearly 100 years of life. He said, "I just played the hand I was dealt in order to get as much advantage as I could." It's so simple, right? Yet this grounded, incredibly pragmatic philosophy is the absolute bedrock of what we're talking about today. It's really not about being the smartest person in the room, it's about being the most rational.
And what does that rationality actually look like in practice? Well, it looks like this. $160 billion. That is the massive cash pile just sitting on Berkshire Hathaway's balance sheet. When you play the hand you're dealt and patiently wait for that perfect, fat pitch, you don't just swing at everything. You accumulate the resources to strike only when the odds are overwhelmingly in your favor.
To truly grasp how they built this, here's our roadmap for today. First, an era transitions. Second, the Munger mindset. Third, the Buffett blueprint. Fourth, decoding financial statements. And finally, soldiering through.
All right, let's hit section 1, an era transitions, the end of an investing dynasty.
Understanding their framework is more urgently relevant today than it's ever been, mainly because the investing world is experiencing some major chronological shockwaves right now. In November 2023, Charlie Munger passed away at the age of 99. Then, in May of 2025, Warren Buffett made this surprise announcement that he's stepping down as CEO at the end of the year. And the market's reaction? By June 2025, Berkshire's A and B shares actually slid more than 10%, briefly falling right into correction territory. The era of the founders is transitioning, and that's exactly why we need to crystallize their strategy right now.
Moving on to section 2, the Munger mindset, the psychology of wealth.
And this brilliantly illustrates the core difference in their approach. The standard Wall Street method, it's frantic. It's swinging at every pitch, constantly trying to outsmart everyone else with these brilliant, complex moves. But the Munger approach is the complete opposite. It's literally just sitting on your hands. It's aiming to consistently avoid stupidity rather than striving for constant brilliance. You just wait and wait until that undeniable fat pitch comes right across the plate.
But why was Munger so intensely focused on risk and patience? Well, it goes all the way back to his childhood during the Great Depression. He watched his family, uncles who were super talented architects and builders, get utterly clobbered by the economic collapse and some really terrible family tragedies. For Munger, investing wasn't just about getting rich. It was a survival mechanism. It was about structuring your life and your finances so that a bad day or even a bad decade couldn't wipe you out completely.
Which brings us to section 3, the Buffett blueprint, from philosophy to execution.
So how exactly do you take that survivalist, patient philosophy and turn it into the greatest compounding machine in history? Well, early in his career, Buffett followed his mentor, Ben Graham. Now, Graham's method was all about finding undervalued, often bad businesses, what they famously called cigar butts, taking one last free puff and floating to the next. But Buffett, who was heavily influenced by Munger, upgraded this entirely. He realized that the real, explosive money isn't in cheap cigar butts. It's in buying wonderful businesses with durable, long-term advantages and just holding on to them as they compound over time.
Let's move on and see how this builds into their actual hard technical analysis. To find these wonderful businesses, Buffett breaks down a company's financial health into 3 essential steps. Step 1, the income statement. Step 2, the balance sheet. And Step 3, cash flow.
Section 4. Decoding financial statements, the math of advantage. Now, what's really interesting about this slide is that this is where the qualitative philosophy turns into cold, hard math.
If you want to invest like Buffett, you absolutely have to speak the language of business, which is accounting. Step 1 is the income statement, and it all starts with this one crucial metric, gross profit margin. This is simply the money a company makes off its total revenue after you subtract the cost of raw goods and the labor used to make them. So why does this matter so much? Because it immediately tells you if a company has pricing power.
Buffett turns this definition into a really strict, actionable rule of thumb. If a company has a gross profit margin consistently above 40%, Buffett sees a durable competitive advantage. It basically means they don't have to compete solely by slashing their prices. Now, if it's between 20 and 40%, you're looking at a highly competitive industry. And if it's below 20%, it's fiercely competitive, with basically no long-term advantage. You're just fighting a race to the bottom.
Once a company actually passes that gross margin test, Buffett rapid fires through these specific heuristics. He wants selling, general, and administrative expenses, or SGA, ideally under 30% of gross profit. He looks for a net margin consistently above 20%. He absolutely demands a 10-year steady upward trend in earnings per share. Over on the balance sheet, he wants to see so little debt that the company could literally pay off all its long-term obligations in just 3 to 4 years. And on the cash flow statement, he strongly prefers companies that repurchase their own shares, which drives up the value for existing owners without triggering taxes the way a dividend would. Honestly, this is the exact math of a business that practically runs itself.
But what happens when a wonderful business stops being wonderful? I mean, Buffett isn't blindly loyal. Take Johnson & Johnson, for example. They were once a massive holding, peaking at around 62 million shares. But when J&J messed up and lost much of its formerly great reputation, Buffett reacted. He slashed Berkshire's position way down to 29 million shares. When the fundamental thesis breaks, or the reputation falters, the blueprint dictates that you adjust, no matter how famous the name is.
All right, final section. Section 5. Soldiering through, synthesis and resilience. So the crucial point is this. Think about it. Munger survived the Great Depression, the heartbreaking loss of his son to childhood leukemia, and endless market crashes over his lifetime. His ultimate life lesson wasn't some hot stock tip. It was this quote right here. The iron rule of life is everybody struggles. If you soldier through, you can get through almost anything. You just can't quit. Whether it's a 10% market correction or a devastating personal tragedy, you literally just have to keep moving forward.
And that resilience? That's exactly how Charlie Munger reached this number. 99 years old, a century of compounding. And we're not just talking about compounding money here, but compounding patience, compounding learning, and compounding wisdom. Time is the ultimate multiplier, but that's only true if you have the mental fortitude to stay in the game.
Which leaves us with the ultimate question for you to ponder. We know the math now, and we definitely know the mindset. But the true test is application. Can you patiently sit on your hands and wait for your perfect financial pitch while possessing the mental toughness to soldier through the market corrections and the inevitable personal setbacks that life will throw at you? That is the real Buffett Munger legacy. Internalize this blueprint, and I'll see you in the next explainer.